Welcome to this week's Sustainable Ethical Investment News and Analysis to Profit By from the Soul Investor. I'm Ron Robbins, an ethical investing pioneer for over 40 years, interviewed and quoted in the Wall Street Journal, MarketWatch, the Globe and Mail, and numerous other global media, and founder of the world-acclaimed Sustainable Ethical Investing information website, Investing for the Soul. Now, I will inform you if I hold any positions in the companies mentioned in this podcast. Furthermore, any favorable or unfavorable comments I might make concerning companies should not be considered investment recommendations, and I do not guarantee the accuracy or incur any responsibility of any information herein. Investors should seek their own counsel in investment matters. Hello, Ron Robbins here. Welcome to the podcast, 23rd of November 2018. For links to all the news I'm covering today, go to my Investing for the Soul homepage. And incidentally, if any terms are unfamiliar to you, a good source for their definition is INVESTOPEDIA, and I have the link with my podcast notes, which you can go to going to the podcast page on my website. So here's the news for the week ending the 23rd of November. Green Finance, a Contrarian Take by Thomas Hale, November 15th, 2018 by FT Advisor UK. And he's quoting that article, Renaissance's argument thereafter is that even if emerging markets have far lower ESG scores, directing capital their way allows for the highest overall rate of improvement, and so the greatest ethical utility. This is, unsurprisingly, an argument for more investment in emerging markets. Few points here. The argument presented by Renaissance Capital, a Russian investment bank, is equivalent to the idea of investing in companies who are just beginning to engage in ESG seriously so as to take advantage of their possible rapid stock price as they're identified as a potential high ESG company. As it's recognized by many investors that high ESG scoring companies also now have a premium to their stock prices. The second point, Renaissance produces a wonderful graph showing how high GDP per capita is highly correlated to high ESG country scores. Third point, another quote I just want to use from this article. As a side note, the report finds virtually zero correlation between ESG scores and sovereign bond pricing after adjusting for per capita GDP. Again, the argument here is going for up-and-coming ESG performers in emerging countries could be a greater bet for stock or bond outperformance. The next article I want to cover, From Upstream to Mainstream, ESG at a Tipping Point, November 15th, 2018, by In Research and Calvert, Investment News USA. Quoting from that article, in a year's time, the percentage of millennials expressing a high level of interest in ESG investing jumped from 26 to 35%, advisors say, while the percentage of Gen Xers embracing ESG spiked from 16 to 25%. This is more than a generational story, however. 26% of ultra-high net worth investors now show a high level of interest in ESG investing. Advisors say up from 10% in 2017. Similarly, interest among very high net worth investors shot up from 13 to 19% in a year's time. So here are my points concerning this post. These results are from a US survey of 300 advisors. The jump in numbers over just 1 year is impressive, and it demonstrates just how fast ESG is being accepted. The second point, somewhat interesting, is that it's regular advisors reporting the rapid growth. Generally, advisors have been really behind the curve regarding their positivity concerning sustainable ESG and ethical investing. Now many are hurrying to get familiar with it. Third point here, Calvert, a well-known and respected ethical investing mutual fund manager, was involved in this too, in this research study. Not sure if this fact had any relevance to the conduct and results of the survey. However, knowing Calvert, probably not. Again, you can go to my site and download the full report. The third article I want to cover from my homepage is Are ESG ratings the new credit rating for stock prices? This is by Jean Jazala, November 19th, Think Advisor USA. And a short quote here. A new MSCI study of ESG ratings finds they have a similar impact on share prices as do credit ratings. First point on this, though to me the findings are unsurprising, it is the first study to demonstrate that ESG ratings have a similar impact to credit ratings on a company's stock price. This finding will no doubt be challenged, but comes at a time when investors everywhere are looking at the inclusion of ESG criteria in their investment research. It bodes well for the mainstreaming of ESG. A second really interesting point. Many credit agencies ratings Many credit ratings agencies such as S&P, Moody's, and Fitch have long been criticized for potential significant conflicts of interest and bias. After all, they take clients' funds to provide new issue ratings on their products and have historically been slow to act in changing their ratings, particularly negatively to new customer circumstances. So since ESG ratings companies such as Sustainalytics, MSCI, Rebecca Sam, etc. don't take funds for their corporate ratings, at least as far as I know, these ratings agencies, ESG ratings agencies, may well be even a greater and better indicator of corporate safety than the credit ratings agencies. And this is why this could be so revolutionary. Fourth and last article I want to talk about, companies leading on disability inclusion outperform peers. This is by Megan Amrich, November 20th of Triple Pundit USA. Quoting from her piece, Accenture, in partnership with Disability and the American Association of People with Disabilities, has released Getting to Equal, the Disability Inclusion Advantage. This report looks at both the disability practices and financial performance of 140 companies over the past 4 years. Companies that embrace best practices for employing and supporting more people with disabilities in their workforces are several times more likely to outperform their peers financially. Here are my points regarding this piece. 1, this is a pioneering and worthy study. It might also be true that employees with disabilities feel they have to prove themselves and so are more productive. Hence, forward-looking companies know this and so increasingly employ individuals with disabilities. Thus, such employment is not always out of charity. Second point on this article, one has to wonder too, however, is that highly profitable companies feel they are able to hire more persons with disabilities because of their high profits. Thirdly, are such companies also aiming to create even higher reputation in their communities they serve? Anyway, these are very valid points, and let's hope that more people with disabilities do get employment, and it seems to be at least quite positive for companies and for the individuals with disabilities too. So that's the news I want to cover. Now to the subject that I want to cover this week, and that is, what are the best ESG sustainable ethical indices? The range of indices is immense today. When I began to follow these around 2001, there were just a handful globally, and mostly unknown. Today, it's extraordinary the number of them and what they cover. The idea of these indices are that they can act as benchmarks for you to assess your own performance. Furthermore, there are numerous mutual funds and ETFs that you can purchase that are based on them. For a really good listing of what is available, go to my page, Ethical Investing Stock and Bond Indices, under links. But here are my favorites though. Concerning equities indices, the first one is Dow Jones Sustainability Index. This is one of the oldest index families and an ethical investor's favorite. Quoting from their homepage, the family was launched in 1999 as the first global sustainability benchmark and tracks the stock performance of the world's leading companies in terms of economic, environmental, and social criteria. This index is compiled and analyzed by the Swiss organization Rebecca Sam. They review some 10,000 companies annually. A second set of indices that I like are the fossil-free indices. The fossil-free indices are a suite of benchmarks designed for investable products that provide broad market exposure to index investors who wish to divest from fossil fuel companies. These investors are typically motivated either by a concern about unacceptable levels of climate change or by a concern about overvaluation and risk in the sector. These indices are capitalization weighted, meaning that larger companies have a bigger influence in the index, smaller companies a smaller weight. This is usually a good way to go. The next set of indices I really like, FTSE for Good Index Series and FTSE Smart Sustainability Index Series. The FTSE, that's FTSE for Good Index Series, is designed to measure the performance of companies demonstrating strong environmental, social, and governance practices. Transparent management and clearly defined ESG criteria make FTSE for Good indices suitable tools to be used by a wide variety of market participants when creating or assessing responsible investment practices and products. Third one, also by FTSE, is the FTSE Russell Green Revenues Index Series. Now this is unique. FTSE Russell's Green Revenues Data Model and Green Revenues Index Series track companies that generate green revenues, a critical component missing from current sustainability models. Now investors can accurately identify and support their investment in companies that stand to benefit from the world's transition to a green economy with consistent, transparent data and indices. I really like this concept of this index with its scoring based on green revenues. That means industries such as tobacco won't score highly, whereas in other ESG sustainable indices, they could. Because after all, these other indices mostly look at the way the company conducts itself in terms of its operations. They don't look at the relevancy of their products and services to the environment or to health and so forth. So I really like this index, the FTSE Russell Green Revenues Index series. Another good set of indices, MSCI ESG indices. With 40 years of experience in index construction and maintenance, MSCI aims to set new standards for ESG indices, allowing clients to more effectively benchmark ESG investment performance, issue index-based ESG investment products, as well as to manage, measure, and report on their compliance with ESG mandates. NASDAQ Green Economy Indices are the next one. These are quite interesting too. What I like about these are that there are separate indices for various types of alternate energy sectors, such as solar and wind, plus indices focusing specifically on water services and products, for instance. Quoting from their site, NASDAQ OMX offers a complete family of indices tracking the growing environmental and clean energy sector, also known as the green economy. Green economy is a shift of economic development towards sustainable practice in business and infrastructure. And finally, in this specific global equity indices that I favor are the S&P Dow Jones ESG indices. They truly offer something for most any sustainable, ethically oriented investor. And specifically in Canada, there's a Jantzi Social Index, which I like. I've known Michael Jantzi, whose firm established this index, since the 1990s. He is head of and founded Sustainalytics, now one of the world's leading ESG ratings agencies. Quoting from the Jantzi Social Index site, in January 2000, Jantzi Research launched the Jantzi Social Index, partnered with Dow Jones Indices. The JSI has socially screened market capitalization weighted common stock indexed, modeled on the S&P TSX 60, consists of 60 Canadian companies that pass a set of broadly based environmental, social, and governance rating criteria. The JSI has begun to generate the first definitive data on the effects of social screening on financial performance in Canada. And if you go to their website, you can see that it really has outperformed the Toronto TSX 60 for some time now. And on the bonds front, there's 2 or 3 out there, but the one I particularly like is the S&P ESG Sovereign Bond Index family. And quoting from their site, the S&P ESG Sovereign Bond Index family offers investors exposure to the same sovereign bonds as standard cap-weighted sovereign bond indices, but tilts the country weights towards more sustainable countries. Again, based on Rebecca Sam's work in terms of their coverage of ESG corporate and country-wide data. So that's all I have for you for this week. Again, please go to my podcast page and download the transcript where you'll get not only the transcript but all the links to everything that I've covered here. So thank you very much for listening and have a truly great week ahead. Bye. In the text below, click the links for my easy and unique 1-hour do-it-yourself ethical sustainable investing pays tutorial to create a sustainable ethical investment portfolio that reflects your values. Also, sign up to receive my free monthly e-newsletter, The Soul Investor. Your email address is never sold or used by anyone but me. And view my investingforthesoul.com site for all the latest incredible sustainable ethical investing news, information and commentary. Please come again next week. Thank you.